Hello, folks. Good Friday morning. I guess afternoon for some of you if you're joining on the East Coast. Hi, Tyler. Hi, Lee. Here we go. Grant, do you mind note takers? Usually we.
Doesn't matter to me. Yeah. The more the merrier.
Here we go. Good morning. Good morning. Hi, Maddie. Hi, Mike. Maddie and Mike are here from
Morning.
Village Wealth as well. Um, Mike and Maddie, if you could just help me with the letting people in, that would be great. Love it when people have their cameras on. It makes us feel like we're not as lonely up here. It's nice to see your faces. Thank you. We appreciate it. Okay, well, we are going to have an active conversation today, so we're going to jump in and get started. We are welcoming back today Grant Hensel from Entrepreneurial Capital. He was with us, I think, last month, Grant, not too long ago, and volunteered to come back so readily that we thought, yes, let's put you back in the schedule. And we had some technical difficulties the day Grant was here with us. So we are doing another session on a slightly different topic this time. So no SBA, no problem. How to structure and close deals anyway. If you want to catch Grant's last session, you can find that on Village Wealth's YouTube channel and just go to our video library and it is posted there as well. And you can catch up on what we chatted about last time. Just a bit of housekeeping. My name is Liz McRae. I'm a co-founder of Village Wealth, and you are joining us today for our Friday speaker series. We also do open office hours every Friday morning for our premium subscribing members. So if that is of interest to you, feel free to join us for those. If you're new to Village Wealth, we are a deal management platform that has been built for buyers. We are a place that hosts over 60,000 listings. We have a deal management dashboard where you can track all of your opportunities that you're considering and evaluate them in-app using the AI analysis and deal structure calculator and financing tools within the platform. So we welcome you to test it out. We work with ETA accelerators and incubators, ETA communities, lenders, investors, brokers, and M&A advisors within the platform. So if you're in any of these categories, we'd love to chat with you about how we can work together. The premium subscription that we offer is $99 a month, but we do have a 2-week free trial as well when you first test us out. And that gives you access to the full marketplace, daily notifications of new deals, weekly open office hours, as I had mentioned, and the full deal management and analysis software all in one. So we welcome you to try it out if you haven't already. Now, please feel free to introduce yourself in the chat. Where are you from? We love hearing where people are from, what your role is in ETA. So if you're a searcher or you're new, you're an advisor, please let us know. It's nice to know who's in the audience and gives Grant some context today as well. I'm going to briefly introduce Grant today, and then he has a short presentation, and then we have questions. So we will roll into Q&A, but ask questions as we go. We're not going to leave all the Q&A until the end, so feel free to ask as we go. Grant is open to all of the questions, so let's have a lively conversation today. That's when everyone gets the most out of these sessions. And that's why we run them in meeting format so that you guys can participate with us. So a little bit about Grant. He is the founder and general partner of Entrepreneurial Capital, a $12.8 million fund focused on investing in entrepreneurship through acquisition transactions. He has been a small business owner for the past 9 years, building and operating a company he founded that employs 60 people today. Grant and his wife have also acquired a business together, which she now runs as CEO, giving him hands-on experience across founding, acquiring, and scaling owner-operated businesses. And now he sits in the fund space, and we are delighted to have you here with us again, Grant. Always fun. And so I'm going to stop sharing my screen and let you flip over and give you the floor.
Perfect. Thanks so much, Liz. And welcome, everyone. Thrilled to be here and with you again. I am going to share my screen and hopefully this will work. Okay. Can people see this, hopefully?
Yes.
Perfect. Beautiful. Okay. Fantastic. And welcome, everyone. I apologize that I'm ever so slightly under the weather. So if I sound less or like I sound weird, my apologies. But thrilled to be with everyone. Today's topic, as Liz mentioned, is how to do a deal without the SBA and what the capital structures normally look like, what the searcher economic terms normally look like, what the sources potentially are for debt capital if you don't have access to the SBA. This is obviously relevant for everyone who's not in the United States, where the SBA does not exist. And it's increasingly relevant for everyone in the United States, where the SBA program has continued to evolve rapidly and has just had a lot of changes. And so before doing that, before we jump into the normal content, I wanted to give a quick update on the SBA landscape in the US. Things that have happened that everyone probably knows is that now 100% of the owners of any SBA-backed transaction must be US citizens. Previously, you could be a green card holder. You can't do that anymore. You have to be a US citizen. Additionally, there was an added wrinkle where it seemed like the SBA was saying if you've invested even $1 in an SBA transaction, that it then eventually goes bad, you are potentially banned from all future SBA transactions forever and ever. I was interviewed by a Forbes writer, and we did an article, and we sent a letter to the SBA with other investors asking for clarity because it's not what their policies seem to say. And I know a searcher who has a friend who is a senior person in the SBA, and it's the rumblings we're getting from that is that it seems like maybe this was an accident and that there will be a technical fix because it's not their actual policy. But so that's encouraging, but not yet finalized. So anyway,
So stay
more to
tuned.
come on that, hopefully, but stay tuned. Yeah, exactly. But on to the topic of today, which is non-SBA debt. And there's all kinds of reasons that maybe you want to pursue non-SBA debt. And there are actually quite a few pros to it. It's much more flexible than SBA debt is for a number of reasons. And if you're in Canada, for example, it's the only option. So that's an important consideration. If you are in the US, you don't have the US citizen only restriction. You don't have restrictions about seller rollover equity, which is technically allowed, but only if the seller personally guarantees the loan, which they're not going to do. Doesn't have restrictions on earnouts, which you can't do with SBA loans. And you have less stroke of pen risk, frankly, where you're in the middle of a transaction and suddenly something changes and now SBA is off the table for some reason. And also, I mean, another pro that I'd add here is that SBA has a cap of $5 million and you can't borrow more than that, whereas non-SBA debt, yeah, you're actually less worried about the cap. You're more worried about the floor, where you want it to be a big enough transaction to make it interesting to a non-SBA lender. So many pros. There are, of course, cons, and the cons are primarily the first is the biggest, that it's harder to get. One, because it typically requires you to buy a bigger business, often $2 to $2.5 million or more of EBITDA, although not always. And we'll talk about an example of a transaction we're working on now where the business is just over, it's like $1.3 million of EBITDA. So, and doing non-SBA. It'll typically require more equity. In SBA deals, you can often get away with the minimum is 10% equity, and often you'll see people doing 15% total equity injection. That will basically never work in non-SBA lands. You almost always need more equity. You'll have a shorter amortization period, which means the loan needs to be paid back more quickly, and which means that typically your monthly payments are higher, which is another thing that forces you to use more equity and less debt. And the weird thing is that the interest rate can either be higher or lower. We've seen it both ways, and we'll talk about the different sources of non-SBA debt and what the trade-offs tend to be with their interest rates being higher or lower. The other thing that I'll just quickly add is that it tends to have more covenants. SBA loans have virtually no covenants other than make your payments. Non-SBA debt typically does have covenants around leverage ratios you have to maintain, liquidity ratios you have to maintain, and so forth. And yeah, sorry, great question in the chat. Does the non-SBA jet still have a PG? That's another major positive, is that often it does not. Not always, but often. Like the majority of the time, it probably does not have a PG. So that would be a really important one to add to the pros column. That's a very significant pro. And thanks so much for the questions. Feel free to just throw them right on in at any point. Um, and yeah, okay. And someone said the second SBA glitch part has impacted me. Okay, good to know. Um, correct. Yes. And Matthew is right. No PG, but we'll expect more collateral potentially, either from the business and you borrowing less, or from the business having collateral, or you personally having collateral. Lots of options. Just to level set, because this is often where people think about things as a starting point, is this is what a typical SBA deal looks like. You're buying $1 million of earnings, let's say, at a 4x multiple, and you're probably getting roughly 75% of your purchase price from something like an SBA loan. Maybe you're getting 10% of your purchase price from a seller note, and then maybe 15% is equity from yourself and or other people. And I add this note too, is this adds up to $4 million. You should actually do more than this, because you should have money on the balance sheet at close. So, this is what's necessary to buy the business, and then additional cash to run the business, which will be based on how capital intensive the business is. So 75% senior leverage ratio here, 85% if you count the seller note, and then roughly 15% equity. And the only reason this works is that SBA loans give you a 10-year amortization term. So your payments are spread out over such a long time that they're lower. And often you're buying a business for a lower multiple. And so the debt service coverage ratio works to borrow so much as a percentage of the transaction. This would be, sorry, let me just click these in. This would be a non-SBA deal. So let's say you're buying a little bit of a bigger business. Often people who are buying businesses that are bigger call themselves sponsors instead of searchers. And there are benefits to this. Typically, when you're talking to a non-SBA lender, if you ask them, who do you like lending to more, independent sponsors or searchers, most of the time they will say independent sponsors. Those two things are really similar. And so call yourself a sponsor. Like it's basically the same thing. You view yourself as a sponsor in that case. The bar for sort of your track record, your history, your past accomplishments will be higher, and the bank is going to expect that, or the non-SBA lender is going to expect that. But it's probably helpful for you to describe yourself as a sponsor, because that typically implies a little bit more senior, a little bit more credentialized, and more accomplished in your career. Just quickly glancing at
And
the chat.
I have a question on that, Grant. When you refer to yourself as a sponsor, does that always imply that you have outside investors as well as your own capital?
It depends. Sponsor is a very open-ended and like umbrella term. Technically, right? Like a private equity firm would be a classic sponsor, where they have raised committed capital and now they are buying something. And the phrase independent sponsor is a derivative of that, where you say, I'm still buying businesses. That's the sponsor part, but I'm independent of having a fund. So therefore, I'm raising capital for this specific deal. I've not pre-raised it in like a blind pool type of instrument. Um, if you if you're not raising capital, outside equity capital, you could probably still describe yourself as a sponsor if you want. Or I don't know, that maybe you describe yourself as a family office in that case. If you have, in this case, a couple $1 million or $3.5 million of equity, you can maybe start calling yourself a family office, depending. But all of these things are a little bit nebulous, and there's not necessarily a bright line between the various categories here, which is very fun. I've had a lot of fun trying to explain what the term independent sponsor means, because it's actually so vague. But
Yeah, and I had wondered where it was coming from. Sareem has a good comment there too, that the sponsor also suggests that the personnel not generally uh, is is planning to be involved as the operator, and needs to be clarified with the banks. That's an interesting point. I like that one.
correct. Yes, that's the only piece of potentially negative baggage that you have with the sponsor term, is that often in the most classic independent sponsor model, the independent sponsor buys multiple platform companies over time and puts in a management team a CEO, promotes a CEO, and they effectively act as like a board member, which you probably wouldn't be doing. And that will be a positive in the minds of lenders and investors. What would be even more of a positive is if you've already done like 6 of these, but since you haven't, it's people will view it positively that you are going to be very involved because there's a second level of risk if you say, I'm buying this business and you don't really know me, and we're also going to put in someone else to run it, and you really don't know them, especially if I haven't even figured out who that person is. So that is a great point. Um, and you definitely want to clarify it. And then Tyler has a question about comparable capital stacks in Canada. I don't know, Liz, if you have any comments on that, and I potentially have some.
Yeah, I just responding here to yeah, it's similar in Canada that we would see to this non-SBA, and Eamon is here as well. He can chime in. He works most closely with lenders in Canada from our team. And but go ahead with your perspective as well.
So I obviously have much more experience in the US than in Canada. This is this is similar. I basically took these numbers from a deal that we're currently looking at that is in Canada. They actually lend it in that deal, I think it was 58% of the total sources came from a senior lender, which was a Canadian. They haven't chosen a bank yet. They basically have multiple banks that were interested, and those banks were willing to provide roughly 58% of the total purchase price. The thing about this and the percentage that a bank is willing to provide is often based. The bank typically isn't thinking about it as a percentage. They're typically thinking about it as a number of turns of EBITDA. So if you are if the business does $2.5 million of EBITDA, they're probably not giving you, for example, like more than 3x whatever the EBITDA is. If they're
Yeah.
more conservative, it's probably closer to 2x. If they're really conservative, it's less than 2x. And so, again, the multiple that you're purchasing the business at matters a lot. Um, but yeah, exactly. 2.5 times EBITDA, this is a comment in the chat, isn't a bad rule of thumb for lender appetite. So valuation matters. Exactly. And I'm trying to be a little conservative here because this is, uh, I mean, I get it is roughly 2.5. Yeah. Just over 2.5.
And it's like that's a good the rule of thumb, the 2.5 times EBITDA is good when you're running your modeling, to use that number as a conservative estimate of what the lender would do.
Yeah. 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 I wouldn't bank on 3x, for example. But 2.5 is
Not
more achievable.
impossible, but
Not impossible. Yeah.
need to
No,
be a bit conservative.
for sure. Yeah. Yeah. And a lot of it depends on to what degree does the business have tangible assets that the lender views as helpful collateral? To what degree do you have a relationship with the lender already? To what degree is your background just a perfect match for this transaction, et cetera, et cetera. So, yeah. Interestingly, and the deal that we were looking at, which is Canadian, which does have many attractive components. In that case, lenders were willing to give 10-year amortization, and that's excellent. Like 10-year amortization is fantastic. But you'll more often see like 5-year amortization, or sometimes even 3-year. And those just really stress the cash flow of the business in the first couple of years when cash flow is at a premium, even more than normal. You will notice that there's more components here where there's often maybe a seller note, as in with SBA deals, but maybe now there's an earnout. Maybe there's seller rollover equity. This is very common that there would be some of that. It's helpful. It's a great way to keep everyone's interests aligned. If a seller isn't willing to do any of this, either it's the best business ever and they have tons of competition to buy it, or it's a lack of expression of their faith in the business as a going concern. And so typically you can get some form of vendor take back slash seller note or earnout or seller rollover. And then equity is just more. And so meaningfully more equity, you still need equity for cash on the balance sheet. And when you have a structure like this, the economic terms that prevail in self-funded search land of like a step up and a preferred return don't necessarily work. And so there's a totally different economic model that applies to investor terms in non-SBA land, which we will talk about right now. So there are 3 main components of what, if you are the person putting, let's just say, this deal together. So you're buying this business, 12.5 or $12.5 million, $2.5 million of earnings. Typically, there would be three components. First would be a transaction fee, which is usually 2 to 3% of the value of the business. So in this case, 2 to 3% of the 12.5 million. Let's just call it 2% to make the math easy. 1% is 125 grand, so $250,000. And typically this is rolled as equity. So sometimes it's maybe half cash, but more often it's rolled as equity. And basically that means that you get equity in the business as if you had put in, as if the total raise was 3.75 and you had put in 250 grand of that equity. So whatever the math is on that, you just get that, you own it from day one. You don't have to like vest into it. It just happens. Second thing is salary or a management fee. In this case, you probably are like the CEO. And so these concepts kind of get merged. It's often structured as the greater of 5% of EBITDA or a floor. So in this case, 5% of EBITDA is $125,000. And so there would be a floor that's set above that in this case, probably. So maybe it's like 175 or 200 or something like that. And then if EBITDA grows where 5% becomes more than that, then your cash compensation increases as the EBITDA, 5% of EBITDA kicks in. And then carried interest. And we'll explain what this is because it's kind of a weird concept, but it typically starts at 15 to 20% and then sometimes can increase based on basic performance hurdles. So you call it like a home run clause, where if you just absolutely knock this thing out of the park, your carried interest percentage can increase. Let me just glance through the chat. Okay, so what allowed the lender to give 10-year amortization? It was just a really attractive deal, very stable industry. Business is growing, solid profitability. I think the searcher in this case had some relationships with these lenders in advance, and so they already had a level of comfort with him, which was quite helpful.
What was the industry on that one?
I don't know because I've shared so much about it. I don't know. It was a very like boring and not probably hard to disrupt industry related to like an essential thing. Um,
Service
sorry,
or manufacturing?
is it's related to food. Um, so yeah,
Okay, we'll leave it
cool
there.
business. Um, Okay, yes. And Sarima just has a quick comment relating seller to rollover equity. These significant dilution since new money is coming out on the table. So ensure seller knows that upfront. Correct. Yeah, correct. The seller rollover conversation is big. And the seller is also going from, probably owning the business now with probably no debt or minimal debt to now owning a piece of the new business, but there's new equity coming in that's probably senior to them, and there's also debt. So it's a very different ballgame, and that has to be handled really thoughtfully. Okay, and so then carry. So what is carried interest? Four things to know about it. It basically describes a return waterfall and your participation in a waterfall of returns. And we'll give an example of how that works. One of the nice things about it is it's resistant to dilution. If you end up raising additional equity to buy additional businesses and do some add-ons or tuck-ins, your carry stays the same. Although it could be renegotiated, but typically it stays the same. And that is nice if you end up raising additional equity as the searcher / sponsor, because unless it's deliberately adjusted, it doesn't like get diluted. If there's future equity that's raised in the future, you're just behind that equity in the waterfall, which we'll talk about. It's typically capital gain. It typically gets capital gains tax treatment if structured correctly, which is great. And then it's in addition to your other two forms of ownership. Ownership number one comes from any cash that you personally invest in the transaction. And then ownership number two comes from you rolling your transaction fee and receiving basically like equity as a thank you for putting the deal together that doesn't come with a cash cost for you. So this is an example. This is from a great group called the Investments Lawyers. This is their website, til.law. They actually did our fund documents and are fantastic. This is an example of, let's say you bought this business back here. So $12.5 million, and let's just say $3.5 million of equity went in. And for the purpose of simplicity, let's assume that we're not calculating your proceeds from this from your management fee or your personal equity investment or your transaction fee. We're just talking about the returns from carried interest. So, and for simplicity, we'll also ignore the cash on the balance sheet. So let's just say $3.5 million was invested in this transaction. And then this waterfall describes a world where the business grows or something positive happens, and it's basically sold in a way that produces for every $100 of equity that was invested, $200. And for simplicity, we're going to assume this happens after the first year, which is obviously a little aggressive, but it'll just make the math easier because there's this thing called a hurdle rate. So investors, which includes yourself for your own capital that you put in and includes yourself for your transaction fee, but put in money, and let's just say it's $100. And then $200 of proceeds comes out of this. The business is sold, something really good happens. The business is sold, and $200 are produced. First, people get a return of capital. So you and everyone who invested real dollars gets your originally invested dollars back. And so in this case, you get your $100 back, and everyone who invested gets their dollars back. You then have 100 additional dollars, and that continues on the waterfall. There's typically what's called a hurdle rate, which is almost always 8%. And the hurdle rate says the first 8% of returns will go to people who invested cash unless we get to unless the return exceeds that, in which case there will be a catch up. But first it will go to people who invested cash. And so 8% of 100 is 8. And so people who invested cash will receive an additional $8, leaving $92 remaining. You then have a catch up where it says, if I exceed this hurdle rate, we're going to pretend the hurdle rate never happened. And so we are going to distribute just to you until you've been made whole, with investors sort of getting ahead of in this case, the 20% carry. So the next $2 of this 92 go 100% to you for the catch up. There's then $92 left. And then those dollars and all future dollars are split 80-20. This is 20% carry again. So if there was another $100, this is actually $300. That additional $100 would also be split 80-20 between you and then the owners of equity. And you are one of the owners of equity, but you as the sponsor get the first $20 of each, 20 cents of each dollar of profit off the top once the transaction is profitable and the hurdle rate has been exceeded. Does that make any sense? Or can I answer any questions about carry? I know this is probably deeply familiar to some people and deeply unfamiliar to other people. So if there are any quick ones, more than happy to do it. I would say catch up is standard in the current environment. Yes. Yes, exactly. It is exactly, if anyone has ever raised a fund, so like entrepreneurial capital, this is exactly how our carry works. We have 20% carry, 8% preferred return with a catch up. It's literally exactly this. So if you've ever raised a fund of any kind, it is literally the same thing. And just to quickly explain the catch up makes you whole for cash investors receiving their preferred return if you exceed the preferred return. So the net effect of the catch up is that if you do great, it's like the preferred return never existed, is the moral of the story with the catch up. And okay, to confirm, carried interest relates to an exit event or annual profit as well. It relates to all cash flows. So if the business is making distributions and somehow distributes $200, the exact same thing would apply. And then if you sell the business and it's another $500, or another $500, you will get 100 of those dollars. People who invested cash will get 400 of those dollars. Same 80-20 split from there on out. Is it just a fancy way of saying don't care how much equity you own, but here's the waterfall from a cash flow perspective, but all applied as capital gains instead of income? So it is applied as capital gains instead of income. And it is a way to basically say, regardless of your equity ownership, which will vary based on how much personal money you invest in the deal, you will also, for doing the job of finding and running this business, you will also just get 20% of the proceeds. It's just a, here you go. This is an incentive. What if the plan is to hold the business permanently? Does this still apply? Basically, yes. And you just achieve this through cash flow. Sometimes people come up with different weird structures if that's like 100% the plan, but I've seen this even if it is the plan. It's like the vast majority of transactions use a carried interest structure. Okay. And we'll share these slides if you are curious about any of this. Um, Going back to raising money and trying to make non-SBA deals happen, three, maybe four main sources of non-SBA debt that we have seen personally. So first one is banks, which I divide into two categories. So local community banks, if you're buying a business and they have an existing relationship with like a bank, whether it's a local bank or a national bank, those can be great people to talk to because they have the most comfort with the business of anyone. And they might be willing to make an except, even if they don't usually do like sponsor finance. There's a world in which they're willing to make an exception because they want to keep the customer. They really like them. They have deep comfort with the business, and that's great. Um, there's also local or national banks will sometimes have sponsor finance groups whose job is to lend money to people buying businesses, typically $2.5 million of EBITDA and up. And those can be great. If you can get all else equal, from what I've seen, if you can get a bank interested in your deal, it's probably going to be the best option from a price perspective. The 10-year amortization, very reasonable interest rate on the deal that we were talking about earlier in Canada was from a bank. Um, sometimes amortization will be trickier, but like often it's the lowest cost capital. It's probably not the most flexible capital. So that's the downside, and it's probably the most conservative capital potentially. Another option is private credit funds, and private credit funds are much more flexible, are sometimes willing to go lower. So a deal that we're working on that's $1.3 million of EBITDA has gotten a term sheet from a private credit fund, which is great. The downside of that is that the interest rate tends to be higher. In this case, it's 11% on theirs, which is higher than the norm. It will often involve something called a cash flow sweep, where maybe you just have to pay the interest and then maybe a little bit of amortization, but 50% of excess cash flow will be swept into paying down the principal. In that case, that deal has a 5-year amortization, or it has maturity in 5 years, so you have to basically pay it off within 5 years. And the covenants also tend to be more aggressive, depending. There's lots of ongoing negotiation with that deal with the private credit fund to try and loosen up some of the covenants. And you want to be very thoughtful about covenants, because if you break a covenant, technically a lender can foreclose on you, which much of the time it probably doesn't make sense for them to do, but it's just a position you don't really want to be in. SBICs, small business investment companies, this is only in the US. They're weird sort of hybrids where they can often do debt and equity, and often want to do debt and equity. The debt tends to be also like a little bit more expensive, where you're maybe in sort of like a teens type interest rate. Um, Yes, and great question, Stefan. Both private credit funds and SBICs will often be more open to having some portion of the interest be PIK, or paid in kind, which basically means it accrues. You don't have to pay it in cash. You can choose to, but by default, it just it just accrues. The transaction fees with these also tend to be higher. They might have more due diligence stuff that they want you to do. They might have greater fees associated with you borrowing the money at all. And so these tend to be more flexible and also more expensive. You pay for the flexibility. And then there's always sometimes you can get like some family office wants to lend to your thing, or, there's other people that maybe are willing to be lenders. But I'd say in the vast majority of cases, it's these three groups that are providing the debt capital. If anyone has seen anything that's not one of these that falls in the other category, I'd be fascinated. Yep. Yep. 100%. Yeah. But the due diligence fees are greater. Indeed is the case. Yeah. So there are people who will help you place debt as well, who maybe describe themselves as debt brokers or as like capital advisors, capital markets participants. And yeah, they could potentially help. And you'll often end up paying a fee for that as well. Okay. Really quick, I'm just going to click through these things just so you know they exist, and then would love to do questions. We have a bunch of resources for searchers, and we'll share these slides. A lot of these are US focused, so that may or may not be as helpful, but we've interviewed a bunch of providers. They are here. We have a newsletter. It's free. We have info on these are standard self-funded SBA terms is here. This is my LinkedIn. And then we like investing in businesses, at least 750 of earnings, typically less than a 5x multiple that are just sort of resilient. So low customer concentration, low CapEx, low economic cyclicality. And we would love to hear about them if you are working on anything. So without further ado, happy to answer any questions or just chat because I'm curious if people have seen other things like people who've done non-SBA transactions or invested them or done debt or participated. I'd love to get other people's perspectives as well.
Seems like we have a few in the chat. Serene's raising his hand. Go ahead there, Serene. You should be able to just to
Can
get
you guys
yourself
hear me?
on. Yeah. Good.
Yes.
All right, perfect. Hey, thanks, Grant, for getting this group together and the presentation. I appreciate it. So just by background, number one, I'm based in California. I said CA. Didn't realize there's people from Canada here as well. I'm in California here, so 75 and sunny. Um, And I started off as a self-funded searcher 6, 7 years ago, and then I've just done bigger and bigger deals, and they've kind of started to look more like independent sponsor type situations. So happy to address offline as well if anyone's kind of looking at that model. But I wanted to kind of bring two things to the table today. Number one, this SBA rule that went into effect March 1st, where everyone in the cap table needs to be a U.S. citizen. I'm actually in the middle of a deal right now where that portion was fine. But as a result of that change, now the SBA requires that you list all the people, not just legal entities, but all the individuals in the final SBA application. And if anyone in your cap table is behind on an SBA loan, their own SBA loan, that will just yield an automatic rejection. So in my case, a $2,500 payment is delaying my closing for a multi-million dollar transaction.
Totally. We had
So,
the same thing. Yeah, it was brutal.
and it just, quite honestly, it's not just now, and who knows whether they're going to fix, and it's clearly a glitch in the system, whether there's motivation to fix the glitch or not. It is making the 7A product and related SBA expansion loan products very unattractive for someone like me. Because now, not only do you have to manage your primary guarantors and make sure that they're okay on SBA debt if they have any, everyone in your cap table, right? So in my case, an investor who owns less than 2% of the company and a $2,500 loan payment that they're behind on is causing problems. It's not the place you want to be in, right? As someone who's trying to get a deal done. So um, prior to actually on the same deal, prior to actually pursuing the SBA path, I was looking at non-SBA options and kind of what I mentioned in my last comment here. It is very easy to find debt capital from people that are willing to underwrite 3 million plus, but below that dollar amount, it's like there's almost no loan products available. And I think there's a major gap in the market for ETAs, self-funded searchers, sponsors looking for debt capital in that $1 to $3 million range. You're basically forced to look at the SBA option as the only option, unless you go for like revenue-based financing where you're paying like, you know, you have to pay off everything within 3 years and they're going to charge you like 30% interest essentially. And that's just going to kill the deal also from a cash flow perspective. So I don't know if there's more perspective you guys can provide on kind of that range, $1 to $3 million. Um, but I feel like there's almost no options outside of SBA.
Yeah, I would say far fewer is what we've experienced. We have three. So one, and just some of these names in case it's helpful. Grasshopper Bank has given us a term sheet on like a $2.5 million EBITDA deal. There's this weird private credit fund thing on like a 1.3. That's the lowest I've ever seen by far. Um, and then there's one that it's like 2.3, 2.5, is a community bank in the like that sort of knew the business. So not impossible, but way harder for sure. Um, yeah, and thanks for call outs of Huntington Bank and Main Street Bank. That's good to know. And over to Matthew.
Yeah, thanks for the session, Grant. I think you covered it really well and comprehensively. So my question was more around, I mean, we've talked to a few conventional lenders, not too many private credit funds, but just as you've gone through the discussions with them, how do you get them comfortable with maybe going from 5 to a 7 year term? Like, what are the things that are typically asking you to feel comfortable extending that? Because that obviously is a huge, uh, even the small increase of 2 extra years is huge for DSCR and free cash flow.
Certainly. Yeah, it's massive. Our experience has been we've had relatively low success getting lenders to change what they view as their normal. Like Grasshopper has been willing to do 7 year amortization. Well, they've been willing to do 7 year amortization with a bullet repayment in year five. So it's part of the way there,
Hmm.
not all the way there. And that seems to be kind of their norm. They also, it's weird. They'll give you an option too, where they'll say, it's I can't remember what the term is, but it involves a cash flow sweep where it actually your effective at a steady state, your effective term actually ends up being even less. Um,
I
so
see.
in the transactions we've been involved with, we're like take the 7 year amortization, 5 year bullet
I
versus
see.
the cash flow sweep. But
So just to be clear, you're saying almost all conventional lenders start out with a 5 year term and then some kind of structure maybe to get that out to an artificial 7 year.
that's what we've seen. The only one that we've
Yeah.
seen is actually this Canada one, which they're like 10 year straight line, no problem. But that is
The
a
unicorn.
rare horse. Yeah, exactly.
Yeah.
Yeah.
I could take the
Thank,
Canadian
thank you.
question. The
Thank you.
we have seen 9 in Canada and 10 on the odd deal in Canada. And so to Tyler's question there, are there the same lending limitations for under 2 million in Canada? There are less options, but there still are some big players in Canada on under 2 million EBITDA options. Village has a service to help find debt capital, so it's something that we can help folks look into. The best option is to circle it around to the senior lenders. Sometimes they'll have different different lenses on different industries as well. But we chat about this often in our open office hours as well. Someone else
And
has
comment
mentioned.
from David about
Oh,
Jumpstart Finance. I actually haven't heard of this. I don't know, David, have you had any experience with this group or has anyone? Because that's interesting.
we
Uh,
actually have as well. Sorry,
oh
go ahead,
Oh,
yeah,
David.
nice.
I've only talked to them. I haven't had any experience with them, but basically they've got two product lines. One is kind of the under and one's the over. And the under one they have a bank that underwrites those and basically they do all the underwriting and the bank just signs it. The larger ones they use an angel investor group that basically have some capital that are trying to put somewhere, and they've worked a product together that does that. It is a more complicated structure, probably similar to what you were putting together in the larger deal. Um, but it seems pretty straightforward. I mean, shorter terms, you're not going to get 10 years out of it. They're gonna the lender in this case is going to take an equity chunk. But
Yeah.
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 Their angel investment group is called Biz by Angel. And we actually had Grant on a few weeks ago. So if you go to Village Wealth's YouTube channel, you can find the session with Grant and he talks all about their program. So that's a great one. Yeah. Thanks, David.
JJ asks, has anyone in this group engaged an investment bank to handle their capital raise?
Grant, you guys are tied together with a number of the other funds as well, right? So if someone comes to you guys and you guys take a portion, or will you circulate the deal with some of the other funds in your network? How does that work?
Absolutely. Yeah, we love sharing cap tables with people that we already know are really good and trustworthy and thoughtful people. So yeah, anytime we like a transaction that, and especially if that we're planning on investing in, we have a short list of people that we say, hey, you should really check this out. And most of the time, and they do the same for us, and most of the time people end up wanting to tag team, which is wonderful.
The question there from admin, that's a Canadian focus question. I could take that one. That's does BDC play in the space? Yes, they do. Similar to some of the other lenders that Grant mentioned, their interest rates can be a little bit higher, but they are flexible in some of their other terms and covenants, and so they're always certainly a group to chat with, and they can also be flexible with, principal holiday payments. So in the first year, they might defer principal payments as well. They have some different programs for seasonal businesses and that sort of thing. So they're always worth chatting with. Yes.
Pioneer does also do non-SBA as well. Yeah. Yep.
They need to change their website.
Yeah, I know. It's definitely in the earlier stages. But yeah,
Good to know.
it's just like way harder. But yeah,
Thanks.
yeah. Cool. Well, thanks everyone. We have a while ago, we put together a Google Drive folder where we just downloaded all of the fact sheets from all of the SBICs that we could find. This is US focused, but let me just grab that actually, because I'm happy to share that with people as a resource. And if there are any other questions.
And we
let
will
us
be
know.
sharing the slides of this again. So watch for that in email. It'll come from Village Wealth.
Just make sure this. Yeah, okay. I think
Oh, we
everyone
had
will
a
feel
sale
like
leaseback option question there, Grant. Did you see
yes.
that?
Yeah, sorry. Sale leaseback is involved in a deal. Does the sale leaseback surplus count towards the sponsor's equity? It depends. I mean, often, like effectively, yeah, because it's cash, and especially if it's being done simultaneously with close, um, that provides a source of cash, which is very helpful for working capital or just equity injection. So yeah, sale leasebacks can be great. And there's all kinds of, I mean, if you listen to the Acquiring Minds podcast, there's some crazy episodes of, and these are rare, but situations where a lot of the purchase price or the equity injection has been funded through like a sale leaseback, and then maybe um, like leveraging borrowing against the inventory or the receivables of the acquired business. There's a crazy story of someone who bought like I don't know, a business for like $50 million with like $6 of his own money, which doesn't count transaction fees. And those were significant, but still kind of impressive. Rare, but lots of options.
Any other questions on the waterfall again? Circle back to that for a second.
Boom, a perfect
Yeah.
waterfall explanation. First time in the history of the world that that's happened, but it's great. And the slides will be helpful as well if you want to look through the diagram again. Oh, sure. Here's a good one. The difference between the American and the European waterfall. It only applies if you're making multiple investments. So it really only applies if you're making a fund. But the European waterfall says investors have to get all their money back first and then carry kicks in. Whereas the American waterfall, greedy Americans, says that it can be on a deal by deal basis. So if one deal does great, the sponsor slash, the person getting the carry can earn carry on that. If you're buying an individual business, you'll always have a carry arrangement that's specific just to that business. So it doesn't really matter for like sponsor type individual business transactions, but it's a good thing to whip out at cocktail parties is the difference between an American and a European waterfall for sure. Are the investors and are the investors in a sponsor automatically investing in additional deals, or is this a standalone? Or it's standalone. So it would be you as the sponsor are raising capital on a deal by deal basis. You're raising money for a specific deal. I unfortunately do not have experience in transactions in Europe, but I wouldn't be surprised if others on the call might. Yes. Okay. This is an interesting one. We've done deals north of 20 million with SBA 504, which is the real estate component of SBA lending. I don't know if anyone else has experience that they can share on that, but that would be interesting. Or JJ, if you want to speak to it. And if you're not in a place where you can unmute, totally no worries. Feel free to put in the chat, or I guess if people have thoughts, maybe reach out to JJ. Briefly on the waterfall, can you talk through an example where dividends happen over a longer period of time? So, for example, Yep. Okay. Yeah. Segregation assets is worthy approach. Yeah. If you're buying something which has a bunch of real estate, you can buy it into like a property company where you can, that's much easier to get lending against is physical real estate. Um, so let's say in a waterfall that instead of getting $200 all at once, you're getting 4 increments of $50. They basically flow through that same waterfall, which I'll share my screen again and show, um, except one at a time. And the reason it's called a waterfall is that um, if you imagine that each of these sort of stopping points are like different pools of water that have to fill up. So the first $50 goes through the pool and it has to fill up this bucket. And so it all goes in this bucket because now the bucket's half full, which is the return of capital bucket. Then the second $50 goes through and it fills up this bucket. And that's it. And then the third $50 goes through and this bucket's already filled. It's already filled. And so it overflows into this next bucket. This bucket is still $8 to the capital providers, and now $42 overflows. It then overflows into the catch-up, still $2 goes to you, and now $40 overflows. And then those dollars are an 80-20 split thereafter. And so when the next $50 comes through, this is already full. Oops. This is already full. This is already full. And so it just goes into the 80-20 split again. And all future also goes into the 80-20 split, which is why it's called a waterfall. Yeah, checkpoint finance is also a good one. Each of these are effectively checkpoints. Like each of these rungs of the waterfall are effectively checkpoints. That's great. Are there any secondary vehicles that you see working well in the next 5 years for assets we'd prefer not to sell? There's at least one group whose name I always forget that is doing a fund to do secondary buyouts of equity interests in ETA type transactions. And so that could be interesting for you or for investors in your transaction. I can't remember what the name is, but they have raised money and they've started making investments, and I'm happy to track that down if it's relevant to anyone.
Grant
And
Ferguson also talked about their fund Biz by Angels doing secondary buyouts as well. So that
cool.
he chats about that in that episode I mentioned.
Cool. On the financing front, is the rule of thumb the ratio about how much commercial debt lenders will offer based on EBITDA? It's often in that like 2.5x, maybe 3 if you're just the greatest deal of all time range of EBITDA. So it's typically as an EBITDA multiple. And then any other tips on how you approach defining the cap stack pre-LOI? I mean, all of the normal ones. The like earnouts are a great way to bridge differences in valuation based on differences in expectations of how the business will do post-close. Rolled equity can be great because if a seller thinks that the business is going to do so well in the future, and you also have that confidence, you can just let them participate. But yeah, all kinds of, I don't want to, that's a whole topic in itself, but tons of ways.
Yeah. Running scenarios. Run your scenarios.
Yeah, right.
On that one,
right.
Like tips, like run scenarios on different the amortization periods, but be conservative going into your negotiations because you want to avoid retrading if possible.
100%.
If you get better terms, then great, but at least you're avoiding retrade if possible.
Yeah. Sponsors working on multiple deals at the same time, do investors have to be aware of this? My rule of thumb is if you are buying businesses, especially if you're trying to do multiple deals at the same time, you are a repeat actor in the space of acquisitions. And if you're planning on doing this over time, your most valuable asset that you should protect at all costs is your reputation. And so transparency is crucial. And I do think especially if you're planning on buying both of the businesses, if you don't tell that to either of the groups of investors, they are going to feel pretty upset if that ultimately transpires, and it will if you buy both of them. And so I would definitely tell them because I think that's very negative to your reputation if you don't. And it's also a good thing to tell them because one of those deals could easily fall through. So you probably kind of want investors thinking about both of them such that if one falls through, maybe they just go over to the other one, just like you're going to over to the other one.
great last advice. We're coming up on time here, so maybe one or two more questions if anyone has them. We do have a hard stop at the bottom of the hour, so we'll start to wrap up here soon.
Someone's partner's working on multiple deals at the same time. I want to know what they're having for breakfast. Exactly. Exactly. Yeah.
That's a strong
Yeah.
pipeline.
Yeah. And pre-LOI is fine. Or if like you got one under LOI, but maybe you're keeping some conversations warm, totally great. It's impressive. Like, I mean, that's a lot of, and if you can do it, just tell everyone, like, look, we got two things in the hopper. But yeah, that's impressive. David's called out. So we're gonna have to be getting David's breakfast order immediately. That is awesome.
Great. Well, this has been great discussion, everyone. If you have specific topics that you want us to cover, you want us to have Grant back in, you want us to have anyone else in on a specific topic, throw it in the chat. Let us know. You can also always submit on Village Wealth what you'd like us to find to present on, and contact us directly. Grant, what's the best way? I know, let's mention this again, the best way to get in touch with Entrepreneurial Capital. You've mentioned Peter.
Yes, Peter on our team, especially if you have a deal or want like a quick take on something. You can also reach out to me. Weirdly, LinkedIn is often excellent for that. So this is my LinkedIn.
There you go. If you're watching the chat, Grant's put the contact information in the chat. And request their additional episodes doing deals across US and Canada. Sounds good. We will take that and work on that. Thanks, folks. If you registered on Eventbrite with us today, please be sure to follow along so you get notified of other events. And if you haven't joined Village Wealth and tested out the free trial, be sure to do that. And we do open office hours. Much discussion like this around any topic that you want to throw on the table every Friday morning with Eamon Gamble from our team. So thank you again for joining us. Thank you, Grant. Happy Friday, everyone. And we hope to see you again soon.
Thanks, everyone. And I'm just going to put my slides in the chat if that is convenient,
Perfect.
just so everyone has them.
And then they'll also go out through email with the recording from today as well.
Beautiful.
Great.
Wonderful.
All right.
Thanks
Take
so
care,
much, everyone.
We'll see you next time. Bye for now.